2 fiscal months of 2025, because we're already in that fiscal year. We're not on a calendar year. We're in fiscal 2025 for the U.S. government. And for the first 2 months, the budget deficit in those 2 months alone was $624 billion. That's a 65% increase over the same 2 months a year ago. The first time that the United States government ran a $624 billion deficit for an entire year, not just for 2 months, but for an entire year, was 2009, right? That was immediately after the 2008 financial crisis. And so we had a huge Great Recession, we had stimulus, and we had a deficit that was higher than that. But now, of course, annual deficits are much higher. If you extrapolate the first 2 months of 2025, if you assume that the rest of the month are also 65% greater than the prior months, we're going to be looking at $3.65 trillion deficit for fiscal 2025. Now, of course, that assumes we don't get any tax cuts under Trump, which is a pretty bad assumption. So we're actually going to have a bigger deficit. My guess would be that the fiscal deficit for that year will be over $4 trillion. But if we just stay on the current path and Trump doesn't make it any worse, which is, an outside chance, but assuming Trump doesn't make it any worse, it's going to be the biggest deficit in 1 year we've ever had. In fact, the record right now is fiscal 2020. That's the COVID year, right? Or 3.1 trillion during that year. Or that was, a good portion of the economy was shut down due to COVID, and we had all the stimulus flooding in. The debt is bigger now. And so what does that mean? That means that the U.S. economy is currently getting a bigger fiscal stimulus than it did when the economy was shut down due to COVID. Now, first of all, if the economy was really as strong as everybody claims, why does it need a record amount of fiscal stimulus? When you have a strong economy, that's when the government is supposed to run a surplus, because the economy is so strong, and it's supposed to pay down the deficits that it ran up when the economy was weak. But here, everybody is talking about how great the economy is. In fact, again, I was watching on CNBC today, and this woman was on there from one of the brokerage firms talking about how strong the economy is, saying it's great, the consumer's in great shape. Everything is fantastic. They're really strong. We've never seen the consumers in such good shape. And I mean, does this woman not realize that the consumers just voted out Kamala or Biden, and they voted for Trump because they want to change, because their financial circumstances are so dire? I mean, if consumers were in the greatest shape ever, according to this Wall Street analyst, they would have voted for Kamala, tried to get rid of her because things are so awful, and they were hoping that Trump would change things. Why would you want to upset a great situation, right? So again, these guys are still clueless about what's going on Main Street, right? If you're on Wall Street, you have no idea what it's like to live on Main Street. But anyway, so we've got this record amount of fiscal stimulus. Again, it's like, you're lying in a hospital dead, and you're plugged into all kind of artificial life supports. You got tubes coming out your mouth, tubes coming out your nose. You got blood coming intravenously into your body, right? You're in this bed, and you ask the doctor, well, what's going on? He goes, oh, you're in great shape. You're perfectly healthy. Except if we unplug any of these things, you're going to drop dead, right? So obviously, I mean, the country is in horrible shape. Where would it be without all this stimulus? Now, yes, we haven't been getting as much monetary stimulus yet. That's coming. But we have a record amount of fiscal stimulus. That's these jobs, like pretty much all the jobs created under Biden are government jobs created with deficit spending. So this is a disaster. The better of the numbers as far as expectations, right?
Peter Schiff's insights into the state of the U.S. economy and the inevitable consequences of fiscal irresponsibility serve as a sobering reminder of the need for strategic financial planning. This first part explores why gold and silver continue to be vital assets in a landscape dominated by inflation, mounting deficits, and misguided monetary policy. Schiff highlights a critical and often overlooked fact. The U.S. fiscal deficit is spiraling out of control. For fiscal year 2025, the first 2 months alone recorded a $624 billion deficit, a staggering 65% increase compared to the same period a year earlier. To put this into perspective, this 2-month deficit exceeds the annual deficit for the entire year of 2009, which followed the devastating 2008 financial crisis. What's alarming is that this ballooning deficit is occurring in a period when the U.S. economy is supposedly strong. Schiff points out the paradox. If the economy were truly thriving, there would be no need for such extreme fiscal stimulus. Instead, this deficit explosion reveals an economy propped up by unsustainable levels of government spending, much like a patient on life support. Schiff's observations underscore the precariousness of the current economic model. Rather than addressing structural weaknesses, the government continues to double down on deficit spending, creating a fiscal time bomb that threatens to implode the economy. Inflation remains at the heart of Schiff's argument for gold and silver. He dismisses the notion that inflation is under control, pointing to data that consistently contradicts Federal Reserve narratives. Consumer Price Index, CPI, and Producer Price Index, PPI, figures show inflation stubbornly persisting, with recent months indicating an upward trend. The PPI, often a leading indicator for consumer inflation, has shown year-over-year increases climbing back to 3%, up from 2.2% just a month prior. This signals that businesses are experiencing higher costs, which they will inevitably pass on to consumers. These figures dismantle the Fed's narrative that inflation is transitory or on a glide path to 2%. Schiff argues that the Fed has already surrendered the inflation fight, even if it refuses to admit it. Instead of implementing meaningful reforms, the Fed is poised to pivot back to rate cuts and quantitative easing, fueling further inflation. This inevitability makes gold and silver indispensable for protecting purchasing power. Schiff's recurring theme is that gold and silver are not just investments, but lifelines. As the Federal Reserve exacerbates inflation by cutting rates, the dollar's purchasing power will continue to erode. In this environment, gold and silver offer unparalleled stability. Gold serves as a universal hedge against currency devaluation. Unlike fiat currencies, which central banks can print at will, gold's supply is finite. Its intrinsic value has remained constant for millennia, making it the ultimate store of wealth. Schiff notes that the market often misinterprets gold's price movements, attributing rises to speculation rather than recognizing that it reflects the dollar's declining value. Silver, while often overshadowed by gold, plays a dual role as both a monetary metal and an industrial commodity. Its applications in technology, renewable energy, and other industries create additional demand, amplifying its potential for price appreciation. Schiff underscores that silver's volatility, while intimidating, offers significant upside during bull markets. One of Schiff's most striking analogies compares the U.S. economy to a patient in a hospital, kept alive by artificial life support. The record fiscal stimulus currently propping up the economy mirrors this scenario. While the stimulus creates the illusion of vitality, it masks underlying weaknesses that will surface when the support is inevitably withdrawn. Schiff points to the record levels of government hiring under the Biden administration as evidence of an unsustainable economic model. These jobs, funded by deficit spending, do not address structural issues, but merely delay the inevitable reckoning. This short-term thinking creates a vicious cycle of higher deficits, rising interest costs, and an increasingly fragile economy. Consequences will be severe. For investors, this means taking proactive steps to protect their wealth. Gold and silver are not merely hedges against inflation. They are essential components of a strategy designed to weather economic turmoil. As Schiff often reminds his audience, the time to act is now. Waiting until the crisis fully unfolds will leave investors scrambling to secure assets that retain value in a collapsing system. By recognizing the signs early and positioning themselves accordingly, individuals can navigate the challenges ahead with confidence.
It wasn't really worse than expected. It was as expected, which was bad, right? So the consensus was for an increase of 0.3 in November, and we rose by 0.3. And that was higher than the 0.2 from October. Year over year, CPI was up 2.7, higher than the 2.6 year over year the prior month. So we're going in the wrong direction. Core, ex food and energy, up 0.3 on the month. Again, another 0.3. We've been there for like the last 4 or 5 months in a row, I think. And the year over year core was also up 3.3. We've been stuck at around 3.2, 3.3 for month after month after month. Nowhere near 2%. How Powell can look at these numbers and conclude that we're on a glide path to 2%, it's beyond me. You can't. All these numbers confirm is that inflation is bottoming out and is headed much higher. And it never got anywhere near 2%, especially if you look at the PPI, Producer Price Index, which is a leading indicator for the CPI, because generally the businesses have their prices go up first, and then they pass it on to the consumer second. So the PPI is more forward-looking than the CPI. And there, the numbers were really bad. So the expectation for the increase in November producer prices was 0.3, and we got an increase of 0.4. And that was double the increase from the prior month of 0.2. So we're really heading in the wrong direction fast. On year producer prices was supposed to be 2.6. It's 3%. We got a 3 handle now, not a 2 handle. Last month, the year-over-year PPI was 2.2%. Now it's 3. Now, I've been saying this on my podcast that the year-over-year numbers are going to start to get a lot worse due to the comparisons. And that's what's happening. So now we have a 3 handle. How long before we have a 4 handle? Not long. Look at the ex-food and energy. There, it was a little bit better, actually, because it was only up 0.2, which was the consensus, right? So, and that was a little bit less than the 0.3. But the year-over-year core was supposed to be up 3.2. It was up 3.4. That was much higher than the 3.1 year-over-year from the month before. So the Fed wants 2% core. We're at 3.4 and headed in the wrong direction. Yet the Fed is going to cut rates by another 25 basis points. By the way, the ECB cut rates 25 basis points this week, and Swiss National Bank went for the supersize 50 basis point cut. They cut in half. I think they went from 1% to 0.5%, right? Inflation is going to rear its head in a big way all over the world. The Eurozone, Japan, all these countries that are cutting rates should not be cutting rate. Inflation is going to roar back stronger than ever, right? Worse than what we had in 2001, 2002. That's what's coming. Ex-food and energy year over year was 3.5. So these are strong numbers. Now, on top of that, adding insult to injury were the import-export prices that came out this morning. They were looking for a drop of 0.3 in import prices. Instead, we got a rise of 0.1. And year over year, they were looking for an increase of 1. We got an increase of 1.3. On the export prices, they were looking for a drop of 0.1, and we were unchanged. And the year over year export prices are up 0.8. The month before, they were down 0.1. So again, we are moving sharply in the wrong direction. Inflation is getting worse as the Fed is pouring gasoline on the fire.
Peter Schiff's arguments shine a glaring spotlight on the precarious state of the global economy and the enduring value of gold and silver as shields against financial uncertainty. In this extended section, we explore more deeply how precious metals serve as a bastion for investors amid fiscal chaos, inflationary pressures, and geopolitical shifts. One of the most striking aspects of Schiff's analysis is his dissection of fiscal irresponsibility and its consequences. The U.S. fiscal deficit is now projected to exceed $4 trillion in fiscal 2025, marking one of the largest annual shortfalls in history. This staggering figure reflects a government that has consistently prioritized short-term gains over long-term stability. The implications are profound. A growing deficit means increased borrowing, which places upward pressure on interest rates. This in turn amplifies the government's interest expense, creating a vicious cycle of higher debt and rising costs. Schiff refers to this as a fiscal death spiral, a situation where the government becomes increasingly reliant on borrowing just to meet its existing obligations. Such a scenario erodes confidence in the US dollar as investors begin to question its viability as a store of value. In this context, gold and silver emerge as logical alternatives. Unlike fiat currencies, whose value can be manipulated by central banks and governments, precious metals offer intrinsic value and historical reliability. Inflation remains a central theme in Schiff's narrative. While the Federal Reserve continues to downplay inflationary risks, the data tells a different story. Consumer Price Index, CPI, and Producer Price Index, PPI figures have consistently exceeded expectations, signaling that inflation is far from under control. Schiff highlights the paradoxical reaction of markets to inflation data. When inflation comes in hotter than expected, Markets often interpret this as a signal that the Fed will tighten monetary policy. This interpretation leads to short-term strength in the dollar and weakness in gold. However, Schiff argues that this perspective misses the bigger picture. Higher inflation ultimately reflects the Fed's inability to control price pressures, making gold and silver more attractive as safe haven assets. In fact, Schiff predicts that the Fed will soon pivot to rate cuts and quantitative easing, even as inflation remains elevated. Such a policy shift would be a tacit admission that the central bank has surrendered its fight against inflation, further undermining the dollar's value and bolstering the case for precious metals. Gold's enduring appeal lies in its ability to preserve wealth across generations. Schiff emphasizes that gold is not merely an asset to be traded, but a foundational element of financial stability. Its intrinsic value, scarcity, and universal acceptance make it a unique store of wealth, particularly in times of economic turmoil. Historically, gold has served as a hedge against both inflation and deflation. During periods of inflation, gold's value rises in tandem with prices, preserving purchasing power. In deflationary environments, gold's scarcity and intrinsic value ensure its desirability, even as other assets lose value. Moreover, gold's role in central bank reserves underscores its importance in the global financial system. Central banks around the world have been increasing their gold holdings, signaling a lack of confidence in fiat currencies. This trend, coupled with rising geopolitical tensions, suggests that gold will continue to play a central role in the monetary landscape. While gold often takes center stage, Schiff is equally bullish on silver. Its dual role as a monetary metal and an industrial commodity gives it unique appeal. Silver's applications in technology, renewable energy, and medicine create additional demand drivers, amplifying its potential for price appreciation. Schiff highlights silver's historical tendency to outperform gold during bull markets. This outperformance is driven by silver's lower price point, which makes it more accessible to a broader range of investors. However, silver's higher volatility also means that it experiences sharper price swings, both upward and downward. Despite this volatility, Schiff argues that silver's long-term prospects are extremely bullish. The ongoing transition to renewable energy, particularly solar power, is expected to drive significant demand for silver, as it is a critical component in photovoltaic cells. Similarly, the growth of electric vehicles and 5G technology will further increase silver's industrial applications, creating a perfect storm for price appreciation. A key aspect of Schiff's analysis is the global shift away from the US dollar as the world's primary reserve currency. This de-dollarization trend is being driven by geopolitical tensions, economic imbalances, and the increasing weaponization of the dollar in international trade. Countries like China and Russia have been at the forefront of this movement, actively reducing their reliance on the dollar and increasing their gold reserves. For example, China has been quietly accumulating gold through both official channels and less transparent methods, such as direct purchases from mining companies. Similarly, Russia's fiscal discipline and low debt levels position it as a potential leader in a gold-backed monetary system. This trend has significant implications for the global financial system. As more countries diversify their reserves away from the dollar, demand for gold and silver is likely to increase. Schiff predicts that this shift will accelerate in the coming years, further eroding the dollar's dominance and boosting the value of precious metals. Market misconceptions. The disconnect between Wall Street and Main Street. Schiff also critiques the prevailing narratives on Wall Street, which often fail to reflect the realities faced by everyday Americans. While analysts and commentators celebrate record highs in the stock market, many Americans are grappling with stagnant wages, rising living costs, and mounting debt. This disconnect highlights the limitations of traditional economic indicators, which often paint an overly optimistic picture. For example, while unemployment rates may appear low, they do not capture the quality of jobs or the financial pressures faced by workers. Similarly, GDP growth figures fail to account for the growing wealth gap and the erosion of middle-class prosperity. By focusing on these broader economic realities, Schiff provides a more nuanced perspective on the challenges facing the U.S. economy. This perspective underscores the importance of gold and silver as tools for preserving wealth in an increasingly uncertain environment. Schiff's insights serve as both a warning and a call to action. The current economic trajectory is unsustainable, and the consequences of inaction will be severe. For investors, this means taking proactive steps to protect their wealth and position themselves for the challenges ahead. Gold and silver are not merely hedges against inflation. They are essential components of a comprehensive investment strategy. By allocating a portion of their portfolios to precious metals, investors can mitigate the risks associated with fiat currencies and benefit from the long-term stability these assets provide. Schiff also emphasizes the importance of diversification. While gold and silver should play a central role in any portfolio, they should be complemented by other assets that align with an investor's risk tolerance and financial goals. This might include real estate, dividend-paying stocks, or other tangible assets that offer intrinsic value. In a world of fiscal irresponsibility, rising inflation, and geopolitical uncertainty, gold and silver offer a beacon of stability. They are not just investments, they are lifelines in a turbulent economic landscape. Schiff's analysis underscores the importance of recognizing the signs of economic distress and taking proactive steps to safeguard wealth. As Schiff often reminds his audience, the time to act is now. Waiting until the crisis fully unfolds will leave investors scrambling to secure assets that retain value in a collapsing system. By embracing the timeless appeal of gold and silver, investors can not only protect their wealth, but also seize the opportunities presented by the coming shifts in the global economy. In conclusion, Schiff's insights are a clarion call for a return to financial fundamentals. Gold and silver are not relics of the past. They are essential tools for navigating the challenges of the 21st century economy. As the dollar's dominance wanes and inflationary pressures mount, these precious metals will continue to shine as symbols of stability and resilience.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.